Good day folks, it's Jim here from Orchard Forex. It's Saturday the 25th of September. So the markets have just closed. It was a pretty quiet end to the week really. Not an awful lot going on. The big events of the week of course were the FOMC meeting on Wednesday, at which Jay Powell indicated that tapering is on its way, but he didn't give any specific date. But that has underpinned yields into the weekend and put a slightly bid tone under the US dollar, although in all fairness the ranges are still pretty tight and it's not really going anywhere at the moment. And the other major event of course has been the Evergrande disaster. We still don't know if that's going to be allowed to fail or not by the Chinese authorities. They were due to make an interest rate payment on Thursday of last week of 83 million. That hasn't come about yet, although they do have a 30-day grace period. So that may yet come about. We have to wait and see on that one. And I think that's going to be the big market moving event going forward. There's not an awful lot on the calendar this week. The US GDP will be released on Thursday. But until then, I think we're probably going to chop around sideways until we see any outcome from the Evergrande situation. And I think things are probably going to be fairly directionless. So without further ado, we'll go and have a look at the charts and see what they've got to say.
Okay, so here we are with a weekly chart of the dollar index. As you can see from the latest week, the ranges are very tight indeed. We're not really showing any directional bias. The weekly indicators, if anything, are pointing slightly higher, but they haven't really got any major momentum behind them, I don't think. If we do have a break above this line here, that equates as 93.60 odd. That equates to about 116.65 in the euro. The US dollar could head higher, taking the euro south. The 100-week moving average comes in at 94.35 and the 200-week at 94 3/4. It seems wishful thinking that we're going to get there anytime soon. And as I say, until we get some resolution from the Evergrande situation, I don't really think we're going to. If Evergrande is allowed to fail, I can see that the US dollar will head higher purely on safe haven demand, if anything, and that might allow us to break to the top side. But really, I think for the time being, it's going to be more of the same sideways trade. We'll have a look at the dailies, and here you can see from the daily charts, we've had a week of tight consolidation, really going nowhere. The daily indicators pretty neutral, slightly positive, perhaps if anything. So I kind of still think we might head a little bit higher, but we really need something to provide the impetus to break probably above this previous high here. That's sort of 93 3/4. And until we see that, I think we're going to continue to chop around. On the downside, these lows here in the dollar index, or 93, that kind of equates to about 118 in the euro. And I don't really think we're going to see too much action there. Now we have got the German election this week. I'm not really anticipating any major directional move from that, mainly because with the way that the coalition is made up over there, it's probably going to take weeks, maybe months, to even work out who's governing Germany. So I don't think we'll be able to tell anything directionally from that on Monday. So that's about it anyway for the dollar index. While we're here, I'm just going to look at the some of the shorter duration bond charts, because this is quite interesting. This is a monthly chart of the 5-year yield, and as you can see, we're up at here. This is a monthly chart, as I say. We haven't been able to break above these highs since March, and I do think that there's potential to go quite a bit higher. The monthly indicators look positive, and if we do break this level, which ties in with this low back here, that's back in July, August 2016. So this is a big level. If we do break above this this level here, which is just under, which is 0.95, we can potentially go quite a lot higher quite quickly, which is basically the inflation trade. So these lows here look to be about 1.3%. Now, if this is to happen, then that's going to underpin the US dollar to quite a degree, and that might be, in the longer term, that might be the catalyst that does send the US dollar higher. We have to wait and see on that, and it might not happen at all, but it's certainly worth keeping an eye on. So we'll now go and have a look at the euro and see what that's got to tell us. Okay, so we start off with a 1-hour chart, and its conditions are really pretty choppy. There's not an awful lot going on at all. And I think really for the time being, if we saw it up here at somewhere between the 100-hour and the 38.2% FIBO level, I'd probably be a seller for the time being with a stop loss above here. So a stop loss probably about 118. On the downside, this 116.80 provides a short-term support, and that comes in ahead of the bigger low down here at 116.65. So if we go further forward, we're going to have a look at the dailies, and here we have, that's the 16.65 level down there, and we've got this support going back here. That's back to September 2020, so it's probably 12 months worth of support. If we do go through that level, we're probably heading down to this low here, so 116, and beyond there to below 115. But it seems a very long way away at this point in time. The indicators are really telling us very little indeed. The dailies are neutral, slightly negative for the euro perhaps. The weeklies possibly the same. We've got the 100-day, 100-week and 200-week moving averages crossing here at just under 116, so that's going to provide added support if we get down there. I'm not really looking for an awful lot in the next week. Evergrande, as I say, might propel the dollar one way or the other, but then we've got the non-farm payrolls the following Friday, so that will be pivotal, I think, in terms of Fed policy, and if we get a very good number, we can expect tapering to begin sooner rather than later, and vice versa. If it's a poor number, tapering might not begin till the end of the year, beginning of the following year, but we wait and see on that one. In the meantime, I think some choppy sideways trades, and really I'll be using to 116.60 to 118 as a trading range, and probably confine myself to that for the time being with a tight stop either side. So there's not much else really on the foreign exchange side. We'll have a quick look at dollar yen, and here we have a 4-hour chart of dollar yen. Now, it spent the early part of the week testing support down here at sort of 109. That was when the risk-off period of the week was on, when the Evergrande situation looked like it could blow out of control. Since then, with stronger yields underpinning the dollar, we've actually got up to the range high. So we're up here at so 110.80, and if we do break above here, then perhaps we can head back up beyond the 111, and this peak here is at so 111.65. I don't really think we're going there early in the week. The 4-hour charts are fairly overbought, but they are pointing higher. The dailies are really completely flat, so it wouldn't surprise me to come back at some stage to test this 100-day moving average. That's below 110. And I think for the time being, I'd probably still continue to use that as a pivot. The data that we get coming out of the States this week will probably give us a bit more of directional bias and when tapering is likely to begin. But if yields do continue to remain underpinned, I guess the dollar will continue higher and could see a retest of this level. In the meantime, I'll probably be buying it at around this 109.90 and selling it as we approach this 111.60, 112 area, and I don't really think we're going to be trading outside that. I doubt we'll see either side of that range, to be honest, but time will tell. So the rest of the currencies, for sterling, read the euro, I think we're probably in a range 137.50 to 136 basically, and if we were to go under 136, back down to this low 135 3/4. But in the coming week, I don't really see an awful lot of action. The Bank of England didn't provide any huge directional bias during the week, so and we've got precious little data coming this week for sterling, so I think it's probably going to be more geopolitics that drives direction than data, and quite honestly I think we're in for further choppy sideways trade. The Aussie is equally doing very little. We've got good support down here at this sort of 72.20 level, and if we go through there, then I guess we can head down eventually directionally towards sort of 71, but I don't really see that. On the top side, this sort of 73.20 area is toppish, I think. I doubt we're going to go above there. The daily charts not really showing us an awful lot. The momentum's fairly flat. So we come back to the hourlies. They're pointing maybe a little bit lower, perhaps spacing out. We're sitting near the 100-hour moving average. If we got up to this sort of 200-hour moving average, that's at sort of 72.80. I'd probably be looking to sell there between 72.80 and sort of 73.10. but with a stop loss above this high here, probably about 73.20, 20.30, something like that. The Kiwi, that's pretty much the same as the Aussie, and that seems fairly range bound within the parameters of support, sort of down here below 69.80 and probably above sort of 71 cents. So I kind of trade that range early in the week. The 200-hour moving average at 70.50, that's probably going to be toppish on Monday. So I'd probably sell it above there, but I'd certainly be buying it back if we saw a dip below 70 cents, I think, early in the week. More interesting, I think, is probably stock markets and commodities. Okay, so here we have a daily chart of the S&P 500. And we did see this dip down on Monday when the Evergrande news broke. That scared a lot of people, but it's held the 100-day moving average so far. We had 3 successive days of trying to test it, and then we managed to bounce into the back half of the week. The momentum indicators, which had been pointing quite sharply lower, seem to have turned a little bit higher now. So I don't think we're going to do anything directional this week. I don't think we're going to make new highs, but equally we seem to have built a base at around this 100-day moving average, and that comes in at the moment at sort of 40, just below 43.5. But that's 100 points lower. If ever we were to go through last week's low at 43.05, then I guess we can sort of start taking out some of these lows back here, sort of 42.30, and maybe even down to the 41.45 level. It would take quite a black swan event now, I think, to get it down there. But if the Evergrande thing does fall over altogether, that's going to shake out a lot of investors. So we could yet see a move in that direction. On the top side, I think we close at 44.50. 4,500 is going to be tricky, and the all-time high is up here around this 45.50. So I don't think early in the week, at least, we're like to see either the top or the bottom parameters, and we're just going to chop around unless we get some news one way or another from Evergrande. As I said earlier, the non-farm payrolls in a couple of weeks, they're going to be the main event. The GDP might move the indices around, but I really think the parameters stay intact. The Aussie market, likewise, that fell pretty sharply early in the week. That came down, actually tested the 200-day moving average briefly. It's still 70.60, but we've had a decent bounce since then, back to 73 3/4, and closed the week pretty much on the 100-day moving average at 73.20. Likewise with the S&P, the indicators had been pointing lower, but seem to have bottomed out. The RSIs have recovered somewhat. And from here, I think early in the week, we're probably going to thrash around either side of 7,300. This red line here, this is the previous all-time high, going back to pre-COVID levels. We're just going to have a look at the weeklies, and here we are. We did test it. We broke actually below it, but we've come back to finish above it. So I think this will remain quite decent support if and when we get there, 7,200. But the weekly momentum indicators, they are still unwinding. They've been overbought for a long time now. They're unwinding, but the damage so far hasn't been too great. So I'm kind of constructive on the longer term outlook for the ASX as New South Wales and Victoria begin to come out of lockdown, and we should be opening up the economy, and I think that'll give the ASX a bit of a boost. So I'm still of the buy dips scenario. Although I must say, if we ever did get below this 70-90 level, I'd be a bit concerned, and then I think we'd probably head back down here, as I think I said last week, sort of 68 3/4. But I don't think that's a likely scenario unless Evergrande is allowed to go under, in which case I think all bets are off. Particularly for Australia, it's going to hurt the Australian economy as well. And with China's real estate sector having a huge demand for Australian iron ore, that might take quite a dent. So I think if that was ever to be allowed to happen, we could come back down here and test this, but I'm not really expecting that to be the outcome. Anyway, that's enough for the stock markets. On to oil. Actually, I'll go and have a look at gold first before we go to oil. Okay, so here we have a 4-hour chart of gold, and although I'm quite bullish longer term on gold, at the moment it seems very heavy, and I don't think it's really into buy territory at the moment, particularly if yields do start to head higher. But we've come back down. We're sitting on the 61.8% support of this rally from sort of 1670 to 1830. We're sitting on that. If we do go through that, then I guess we can head back down here towards 17.15, and below there we could get back down here where we saw this spike low several Mondays ago. On the top side, gold doesn't really seem to be above 1800, and I don't think we're going to go there for a while. With this level here, 1785, that's going to be decent resistance early in the week. Then we've got this 1800 level and 1830, which seems a long way off right now. The daily charts, they're looking heavy. So I think we're right now probably selling rallies. If we ever saw a close above this 200-day moving average, that's a 1804, then I suspect we can head back towards this 1830 level. But I think that's something for the longer term outcome. And it wouldn't surprise me. This 1675, I wouldn't be surprised if the market does want to test that at some stage, just to see what stop losses lie underneath there. At which point, if they do get taken out, we could head back towards this sort of 1615 level, but that's a very long-term outlook. Silver, as with gold, silver looks pretty heavy. The 4-hour indicators are not telling us an awful lot, perhaps beginning to turn lower, but we're back down here at 2240 and actually sitting on quite important support. If we have a look at the daily charts, going back here, this is heading back to September last year. So if we do go through this sort of 22.5, 22 level, then I suspect we can probably fairly quickly head back towards 21, maybe below 21. It remains to be seen on that one. I'm not really expecting too much early in the week. On the top side, it looks to me now as though if anything above 23 is probably a decent sell in the short term. With a stop loss probably above 23.5, 23 3/4, something like that. So that's that. Oil, and here we have a daily chart of West Texas, and that's looking fairly positive to me at the moment. I think, as I said in my Friday update on the Discord channel, I think we can probably look to have a fairly severe test of this sort of 74.5 level, above which I think we can probably head back towards 77. There's been some pretty bullish outlooks during the last week or so from various banks suggesting that West Texas can head back towards $100 a barrel. In the near term, I think 77 is probably a little bit toppish. But if we do see the US economy really start to pick up as we head towards the end of the year, then it wouldn't surprise me eventually to see this get taken out, and we could be on our way to higher levels. The daily indicators generally look pretty positive. The week, they look slightly less constructive as far as the indicators go, but the MACDs might be winding up to turn higher. As I say, this 77 level is going to be pretty strong resistance. But if I close the chart up a little bit, you can see that there is room to go higher if we do break above 77, with the next real point of contact not being until sort of 83 3/4, where we get the 76.4% FIBO reversal from the whole move down. So that's it's worth watching. I'd rather be long than short. As far as getting into it is concerned, I'd probably look to be buying it at it's currently at 74. I'd probably be looking to buy a dip towards 72 if we get lucky to see that. Maybe you need to be buying it here, but I'm just going to have a look at the 4-hour charts. And the 4-hour charts, the indicators are suggesting that we are heading higher. It is becoming a little bit overbought. So maybe this particular high here is sort of 73.10. If you're looking to buy it there, it's probably not worth hanging around for, because you might not see the dip. So maybe buying it at current market levels. As far as stop losses are concerned, I'd either keep a stop loss below sort of 71.5, or even better down below $70 a barrel, because I don't think we're going back down there. But you need to be able to leave yourself room to buy dips if we do head back down to 70. Underneath there, underneath 70. I'd really have no interest. I think that's telling us a different ball game altogether. But for the moment, either buy it here or look for a level to buy dips, but with a stop loss under 70. So that's about it. We'll have a quick look at the calendar, and here we go with the calendar. There's not an awful lot on Monday apart from the US durable goods. They're expected to have a better month this month, or for August, 0.6. Then heading through to Tuesday, the BOJ minutes, Australian retail sales, some secondary housing data from the States, and the Richmond Fed manufacturing data. So that's Tuesday. Not an awful lot, as I say, through the week. Wednesday looks pretty empty altogether. Thursday, the Chinese manufacturing, non-manufacturing PMIs, they might create a little bit of activity in Asia, but that's about that. Q2 UK GDP, German and EU CPI, they're on Thursday. And then we've got the US Q2 GDP, as I said earlier, along with the Chicago Purchasing Manufacturing Index. And really that's about it. We've got the Tankan on Friday for dollar yen traders. But really it's there's not an awful lot coming out. We've got the manufacturing PMIs coming out from Europe and also from the States, and we've got the PCE figures as well, but that's really about it. So I think overall it's going to be any headlines coming from Evergrande. Otherwise we're going to be looking forward to the following week when the non-farm payrolls will be released, and that'll give us more of a hint as to when the Fed actually are going to start tapering their bond purchases. So we'll leave it there for now, folks. Have a good one, and we'll talk to you next week. Cheers.